Hello, everyone. Hope you're out enjoying a fun summer. Wanted to share a really quick update on markets and the economy now that we've crossed through the halfway point of the year. At our economic outlook in January, we said you really don't even have to watch your portfolio this year. Just watch inflation, the Fed, and employment. So let's take a look at those three. But first, let's review our asset class returns quilt. You'll find year-to-date returns through June 30th on the far right of the chart. U.S. large cap stocks, that's the S&P 500, have picked up where they left off in 2023, adding 15.29%. A sample diversified balanced portfolio of 60% stocks and 40% bonds produced an attractive 6.5% mid-year return. Laggards include real estate, bonds, and U.S. small cap stocks, all just below the zero line. All in all, markets had a great first half, driven by strong earnings in U.S. large cap companies, and particularly well in light of market expectations coming into 2024 for up to 6 Fed rate cuts this year. And so far, we've gotten exactly 0. But since the end of June, there have been some changes afoot, which we should address. Since the favorable June inflation report was released, expectations for a 25 basis point Fed rate cut in September, that's the right side of this chart, rose to 92%. This would be the first cut since the Fed began its tightening campaign in March of 22. U.S. small cap stocks, represented by the Russell 2000, which have lagged their larger peers over the last 2 years, have rallied over 8%. That's the left side of the chart. Small caps are considered a rate-sensitive part of the market, as these companies generally borrow more than their large counterparts to fund operations and expansion, and they're generally on floating rate loans. Progress on inflation continued in the first half. The Consumer Price Index, CPI, declined in June by 0.1% month over month for the first time since the pandemic began. The drop was driven by lower energy prices and finally getting some relief from the stickiest component of CPI, shelter prices. Shelter had its smallest rise in 3 years. Over the last year, CPI rose 3%, while used car prices fell by 10%. Core CPI, which excludes food and energy, rose by only 0.1% from May, the smallest increase since 2021. Overall, the latest inflation report likely provides confidence for the Fed to consider cutting rates in September, as I mentioned earlier. The labor market continued its gradual slowdown in June, with payrolls increasing by a modest 206,000. June's hiring pace was the lowest average employment growth over the last 3 months since early 2021. This was further highlighted by a downward revision of April and May's job growth by 111,000. However, more people are entering the workforce, which brought the unemployment rate up to 4.1%, which is the highest unemployment rate since November of 2021. As a side note, not shown on this chart, income growth eased 3.9% year over year, the smallest annual increase in 3 years. Another sign of possibly slowing inflationary pressures, giving the Fed yet another excuse to cut rates. I'll wrap up with 2 quick notes. The first is about FOMO. Some disciplined investors may be feeling like they're being left behind by the outstanding performance of U.S. growth, big tech in particular, especially since the AI boom that started in March of 2023. Diversification means never owning enough of a certain asset class and always owning too much of another. But being diversified is a form of regret minimization, because when the tide turns, and history has shown it does turn, you'll be glad you own the other asset classes. Listen, if your job is a trader and you missed getting into a super high-flying growth stock like NVIDIA, you messed up pretty bad. In fact, if you trade for a living, you've probably been fired. But if you're an investor and allocated across these asset classes, looking to achieve favorable risk-adjusted returns over the long term, and of course, it's all part of a solid financial plan, then you're doing well. Part of your portfolio captured these outsized returns from this narrow leadership. Other parts of your portfolio lagged, but the sun is expected to shine on those asset classes again. You have permission to just let your diversified portfolio do its thing over the next 10 years. For our clients, we'll continue to monitor the data and adjust your portfolios accordingly. Lastly, I probably can't emphasize enough that America's choice of president should not affect your long-term investment strategy. We've got 4 ugly months left heading into the election, but history has shown that stocks have performed well under both Democrat and Republican presidents. Half of the country has always been upset and dismayed by the election results, but 100% of those who tuned out the noise made money in stocks over the long run regardless. Enjoy the rest of your summer.